Now, the hard part, we said last month. That was prescient, but to be frank, the turn in markets has been faster than we suspected. European equities have given up about 1/3 of their gains. Government bonds are also catching up with credits. The risk rally this year had rested on 3 pillars, 2 of which now have cracks. First, trade talks have sharply deteriorated. It's not just about tariffs. Individual company sanctions will disrupt global supply chains. Second, the rebound in global growth early this year was flattered by temporary factors. Q2 looks softer on both sides of the Atlantic. Luckily, the third pillar is rock solid. The Fed is getting more dovish, and that to a large extent explains why the risk sell-off has been less severe than in December. The 3 pillars are closely interconnected. The trade war is a major threat to global growth, and clearly the US economy is not immune. US leading indicators are pointing to a significant slowdown, and business surveys are already taking a hit. The tail risk of a recession is getting fatter, and that will keep market sentiment subdued for a while. Uncertainties about Brexit and Italy will also stick throughout the summer. Thankfully, a dovish Fed is likely to limit damages. Inflation has not followed the usual script, and with the economy now slowing, the risk of overheating is gone. We see Fed cuts in 2020, but the chances of an earlier move are rising fast. However, the Fed pillar is not enough to revive animal spirits and growth. At some point, Trump will face the reality principle. If you're not sure what that is, go back to Freud. Twists and turns from Trump are hard to predict, but the direction of travel is not. He wants to be re-elected in 2020, and he simply cannot afford a hard landing of the economy. By the time kids go back to school, expect some softening in the trade stance. We have reduced risk exposure by cutting back on equity and credits overweights, but we still expect those asset classes to outperform eventually through the rest of the year. We retain some overexposure in credit in particular. Credit spreads have picked up a bit, and it's hard to resist the carry when bond yields are so low, unless you think the economy will crash, which we don't. We plan to increase risk-taking later this year once at least 2 pillars look strong again. Once both the Fed and Trump embrace a softer stance, risk assets will recover. The US dollar will then topple from its cycle high, and that should benefit the ailing emerging markets. Have a good summer. Speak to you soon.